Hi, this is Andy Hoffman, Media Director of Miles Franklin Precious Metals, in our 25th year in business. It's Thursday, June 26th, midday, and my God, is there a lot going on to talk about today, and none of it is good, unfortunately. The title of today's audio blog is The Fed's Deathbed, and if anyone's been listening lately, they know that I've really been focusing on the Federal Reserve as the end game of the past year's tapering propaganda scheme is upon us. Last week, we wrote Yellen's Last Stand, as in our view, the comically disjointed, pathetically dovish FOMC statement represents the very end of any remaining shred of Fed credibility. Let's face it, if any such credibility does exist, it's solely due to the overt and covert money printing, market manipulation, and propaganda utilized to mask reality. Last week, we wrote The Point of No Return to illustrate that the mid-2011 financial crisis represented the Minsky moment when the Fed realized all was lost. Well, the Fed and all the world's central banks, at which point money printing, market manipulation, and propaganda became their only remaining policy tools. And I put quotes around the terms policy tools as they're not tools at all. They're simply market manipulators. At that point, concerted precious metals blitzkrieg attacks became regular occurrences, like May 2011's Sunday Night Paper Silver Massacre, replete with false bin Laden capture propaganda. September 2011's Operation PM Annihilation 1, which was right after gold hit its all-time high. Ironically, it was launched within hours of the Swiss National Bank devaluing the franc by 7% and tying it to the dying euro. Then you had December 2011's Operation PM Annihilation 2, equally ironically launched minutes after an unexpected ECB rate cut, replete with fake central bank gold sale headline. And who can forget February 2012's Leap Day violation, launched hours after a much larger than anticipated tranche of Europe's LTRO, or long-term refinancing operation QE scheme, was announced. However, none of those raids, and conversely the equally blatant 24/7 support of stocks and bonds, compare to what we've seen since last April, that is April 2013, when the alternative currencies destruction was launched one day after Obama held a closed-door meeting with the 15 largest too-big-to-fail bank CEOs, including Goldman Sachs, which actually had the gall to issue an aggressive short sale report just hours before gold and silver were taken down by $250 an ounce and $6 an ounce respectively in the space of 2 days. Not to mention Bitcoin, which was also attacked simultaneously. 2 months later, the year-long tapering propaganda campaign I mentioned above commenced, with the compliant mainstream media dutifully proclaiming that this was somehow negative for precious metals, but positive for both stocks and bonds. But here we are a year later, with global economic activity undisputedly at its lowest point since the 2008 bottom, and in many cases much lower, as in Japan, much of Europe, and even China. The US just reported its worst GDP print since 2009, which would have been far worse if it wasn't using a record low GDP deflator, despite a veritable explosion in the prices of need versus want items like food, energy, health insurance, and college tuition. And by the way, God help us all when the full impact of Obamacare is felt, as America's healthcare system is already 10 times more expensive than the rest of the civilized world. And let's not forget the volcanic eruption of debt of all kinds, from federal to municipal, corporate, and individual, not to mention all-time high levels of notional derivative exposure, sovereign and pension unfunded liabilities, off-balance sheet debt, and countless other unpublished horrors. Which is why last week's FOMC statement was so ominous, in its complete and utter lack of a clear message, magnanimous view of the aforementioned explosion of need versus want inflation. Janet Yellen actually called surging food and energy prices noisy, and the willingness of Fed governors to so transparently prostitute themselves toward the cause of kicking the can via laughable propaganda, misdirection, and ambiguity. At least Maestro Greenspan was a good liar, or at least he was working with a much less developed economic catastrophe, as he choreographed the greatest fiat currency failure of all time. Conversely, Helicopter Ben was a two-pit teleprompter reader, while Whirlybird Janet literally has zero communication skills. I mean, her party line towing is so blatant it calls to mind Orwell's 1984, where only a dumbed-down, brainwashed population could believe a word she says, if they're listening at all. This week was even uglier, per what I wrote in Wednesday's Looney Tunes on Parade. More on that in a second. Each day, the real data gets uglier, yet each day, government diffusion indices improve, creating a gap between economic reality and fantasy, much less the rigged financial markets utilized as proof of such, like none before in human history. For instance, we saw another week of 20-year lows in mortgage financing activity, as well as an obvious rolling over of real estate prices and the worst GDP print at minus 2.9% in 5 years. Sure, home sales and prices are up in the 1% of the market where $1 million plus properties trade, care of the free money given to them by the Fed, but otherwise the 99% aren't seeing it. Even with the government now offering the same zero down payment and subprime loans that we saw at the 2007 peak. And don't forget, the government now not only is the biggest owner of treasury bonds, but of mortgage bonds as well, and Fannie Mae and Freddie Mac in the Federal Home Market Group. So basically, they are now the owner of the mortgage market. And so just like they run healthcare, now they're going to be running the housing market. Pretty scary. Better yet, said diffusion indices continue to rise, whilst the employment category somehow barely budges. Business expectations fall, and the surge in the economically negative prices paid category gives the false impression of improvement. Moreover, per the damning table we published in today's article, which is a must-read, called Beach Ball at Record Depths, real April and May data, like industrial production, factory orders, retail sales, suggest flat at best second quarter GDP, no matter how much the PMI and market diffusion indices propagandize growth. And I love when you talk about the top of a bubble of epic proportions. The fact that this company called Markit, Markit, not the government, is now producing all of these diffusion indices, and they just IPO'd at this monstrous multi-billion-dollar valuation, just shows you how degenerated the system has become and how the conflict of interest. I mean, it's no different them than CNBC. Their job is to tell you positive things, just like the government wants them to tell positive things, and CNBC wants to tell you positive things. And by the way, did anyone see, for that matter, that CNBC's ratings hit a new 20-year low this month, and Jim Cramer had his worst month of ratings of all time? Now, the catalyst for the Looney Tunes on Parade article yesterday was the past 3 days of Keystone Cops performance by the Fed governors in their desperate attempt to prove the economy is, quote, recovering, as they do anything they can to support the 2.6% level on the 10-year Treasury yield that we wrote about in 2.6%, enough said, and thus prevent the universal realization of what we wrote of. We called it the most damning proof yet of QE failure. That is, when bond yields are plunging, despite the government saying that there's a recovery, and despite surging inflation, and despite all the despite the supposed tapering. The fact is, the market is betting on QE to infinity, and today is a perfect example. I mean, I didn't even get to today because I published that article yesterday, and here we are with bond yields plunging to 252, despite any discernible news to account for it, other than, as I said, this universal realization of what's actually happening in the world. To wit, we have for months trumpeted our belief that despite surging inflation, Treasury yields would plunge. I mean, ultimately, hyperinflation is going to destroy all the sovereign bonds. But until then, we believe the Japanese Abenomics model is all but guaranteed, in our view. Europe just joined that party with last week's NERP announcement, with promises of a big QE package coming right behind it. And Japan appears destined, if anything, to accelerate Abenomics until the Bank of Japan owns every single sovereign bond in stock. I mean, they just put their whole government pension plan into stocks right now. I just read the other day that the Norwegian This is just Norway, one little country, plans to own 5% of every single European stock with its sovereign wealth fund. And again, this is what happens when you lower rates to zero and you don't give funds that desperately need money to pay their beneficiaries something. You force them into junk bonds, which are trading at record low yields. You force them into stocks, which are trading at record high valuations. Not to mention, we just learned that the global central banks own 29 trillion of stocks, or half of the entire capitalization of the world. Because that the same thing, they're just printing money and buying stocks, and some of them are institutions like pension funds that need to gain yield, so they'll buy anything. But the point is, when you get too big, you have no one left to sell to, and therefore the only way that they're going to be able to keep markets higher or even stable in the future is to hyperinflate, because there'll be no one else to sell to, and that's the end game. It's more, I've said for some time, it's more likely you're going to see markets do a Venezuelan type from last year, or Zimbabwe from 10 years ago, or Weimar Germany from 100 years ago, and hyperinflate, and you lose your money in real terms, than an actual crash, because they've now realized that not only do they have to print the money nonstop, but they realize that they can do it and get away with it. That is, until the end game occurs of currency crash. You look at the just the Chinese yuan devaluation of the last couple of months, and you realize the final currency war has started. Everyone is doing it, and they won't stop. China is going to do it more than any. They've printed more money than any country, probably than all of them combined in the last 5 years, to offset what's going on in the economy. And they've created this historic bubble, which is falling apart in all manner. So again, there's no growth anywhere left in the world, and that's why the Baltic Dry Index is down 60% this year alone, near its all-time lows. Now back to the Looney Tunes on parade analogy. Now consider this set of comical circumstances this week. Tuesday, now again, remember the Fed is all basically doves. And every time they make an announcement, it's always the vote is always 12-1. There's always a token hawk in there somewhere. And then you got one or two token hawks who are never on the voting committee, who they just trot out to give speeches with ambiguous comments about how the Fed is worried about inflation, and even though it's obviously not, because it never does anything about it. So anyway, there's Charles Plosser, who's on the voting committee this year, but won't be next year, ambiguously says on Tuesday, rates may need to rise sooner than expected because, wait, I can't even find his exact quote. But his quote was, he didn't even talk about rates rising. He just said, we might have to change our forward guidance a little more aggressively as we get closer to our goals. I'm not sure what that means, but I guess it's suggesting that rates need to come up before the mid-2015 expectation. And again, even the Fed governors, they may expect to, quote, raise rates in mid-2015, but on average, they're expecting the Fed funds rate to be 1.1% at the end of 2015, which hardly is characterized as rising rates. But anyway, this clown comes on and says this, and right at the same time, there's a 2-year Treasury bond auction, and it goes very poorly, and no one wants 2-year Treasury bonds after Plosser says this. But then again, it's the Fed that creates the Treasury bond auctions. They're still the biggest buyer, they're still the biggest owner, and they're still the ones who control all the bidding. So who's to say that these guys even know what they're doing? It sounds to me like they don't have the slightest clue of how to manage their various manipulation schemes. And the funny thing is, even Zero Hedge is writing, oh, stocks fell afterward because of this poor auction. The problem was, as the 2-year auction was weak, simultaneously, 10 and 30-year bond yields plunged. I mean, bonds exploded, long bonds, when he spoke, and the 2-year bond auction was weak. And of course, look, the stocks went down a whopping 120 points, and as usual, they stopped at exactly 1.0%. That's where the PPT steps in, because they're trying to let you know, oh yeah, you should be worried about rising rates, but not too worried, because don't worry, we'll be in there protecting the stock market. We can't let it crash. So that's on Tuesday. Then on Tuesday night, they trot in Bill Dudley, the guy who was the Goldman Sachs chief economist before he became the second most powerful guy at the Fed, running the New York Fed. And he says, quote, market expectations are that the Fed will start to raise short-term interest rates around the middle of 2015. That sounds like a reasonable forecast, But as you know, forecasts often go astray. So in other words, he's saying, yeah, I have no idea what's going on, and basically, everything Plosser said is BS. And for the record, I published in yesterday's article a list of the FOMC board members and who votes this year and next year. And of course, Plosser will be gone. He won't be voting when at the time when he supposedly was going to do something about it. And next year, just based on the rotation schedule, we are going to have the most dovish FOMC voting committee in the history of the Fed. So you can make your own conclusions as to what's going to happen next year. Then you have Wednesday morning, right after Dudley spoke Tuesday night, the GDP number comes out. We're talking about how did they initially estimate a plus 3% GDP, which became plus 0.1%, which became minus 1.0, then an estimated minus 0.18, minus 1.8, and then finally minus 2.9%. That's how bad things are and how bad the forecasters are. And again, it has nothing to do with the weather. It's been proven. And by the way, last winter, huge plus 3% GDP growth in the first quarter. So I really don't think there was a 6% difference in economic activity because of the weather. And we proved it in an article called Mother Nature Has Had Enough a few months back for anyone who cares to read it. Okay, so then of course on Wednesday when this horrible GDP number goes out, the PPT comes right in and makes stocks go up. From the second the day goes up, and they say, well, it's because people are now expecting the Fed to do more QE. And of course, gold is capped, and all's well. 2.61% on the 10-year yield as they desperately hold on to 2.6%. They just, I'm telling you, that level is the level to be watched because they will do anything to prevent it from going below that. Well, that is until this morning. When Bullard, one of the other presidents, and actually I don't even have my table up here to see if he's on the voting committee next year, he comes in and says, markets don't appreciate how close the Fed is to its goals, and thus it should be pricing in rate increases. Really, you're ordering the market to price in rate increases. And how so? By having the Dow go down a couple of points? Like again, it went down 100 points today and then it stopped cold. Or should bonds plunge on this news? Is that what you want with all the debt you have? With all the debt you, the Fed, have? So what happens when he announces that bond yields should be priced in as going higher? Well, guess what? They plunged. We're talking about the 10-year yield plunge from 260 in the morning to 252 as I write here. Again, way below the 2.6% level and in danger of completely collapsing, which I believe firmly is going to happen as the world realizes QE to infinity is coming. And again, it shows you, as I wrote, Looney Tunes on parade. These guys have no idea what they're doing. They don't even know how to communicate. They don't know how to. They don't realize that the only policy they have is to print money, and they don't realize that the entire world realizes it. As for gold, again, yesterday was COMEX OPEX day, option expiration. So, following last Thursday's big rise, we've seen 3 of 4 days, including today, of just nonstop capping. It's just unbelievable to watch. But the problem is, it's not working because every single day the price is now coming back. In the case of silver, it's really, really strong. I see it's up again today. And, remember, I wrote Battlefield $20 silver a few months ago to show that literally for 6 years, the cartel has been fighting this level because it's such an important psychological level. The problem is that in those 6 years, the cost of mining silver has gone up so much that you really need more like $30 now to sustain the industry over the future. And therefore, there's just no way they're going to be able to push it below this dramatic triple bottom that's been created at 18 and 19. And at some point, we're going to see an utter explosion. I keep writing about the shortages that we've had in precious metals over the last 5 years, but really they've been concentrated far more in silver. And again, up until a few weeks ago, even the U.S. Mint was having rationing of silver eagles. There's just not a lot of silver out there, which is why it's the Achilles heel of the cartel. And I truly believe with all my being that this ridiculous 50 or 60 gold to silver ratio is going to fall back to at least the 15 level that was historic. That was based on the amount of gold versus silver that came out of the ground. And right now that level is closer to 9 because silver is depleting even faster than gold. and it's trading, by the way, much lower, more below its cost of production than gold is. And finally, I'd be remiss if I didn't bring up last Saturday. I went to see the great Jim Sinclair at his Denver meeting. It was the third time I've seen him. The first was in 2004, and then in 2011, and here. And it was pretty shocking. Look, the guy is one of the gurus of the industry. Sometimes he injures himself by giving some very short-term predictions, but it was pretty shocking for him to say that he believes that there's going to be a major attack on U.S. dollar hegemony this fall, and that he believes we're going to see 2,000 to as much as $3,500 gold by the end of this year, and maybe even $70 to $90 silver. Now, of course, for that to happen, we are talking about a loss of control of the powers that be. But when you see announcements like today, where Gazprom says, "Yes, we're going to start pricing oil in rubles and yuan." I mean, Gazprom is almost as big of an exporter as Saudi Aramco, with China and Russia are courting. I mean, there's a lot going on, not to mention what's going on in Iraq and Ukraine, all these things that is going against the dollar and the U.S. hegemony. So it wouldn't surprise me, particularly with the world economy falling apart, and Janet Yellen's Jimmy Shaker Day coming, when she has to announce an increase in QE, if this does in fact happen by year end. And if it doesn't, it's going to happen next year. I mean, it's going to happen soon. I mean, heck, we just saw today or this week, talk about some ominous news for those trying to hold gold down. The chairman of the Shanghai Gold Exchange confirmed that there were 2,000 tons of gold delivered in 2013 from the Shanghai Gold Exchange. And that's more than 1,000 tons that were imported into Hong Kong. That's 3,000 tons, which, by the way, is more than the entire global production of gold. And we're supposed to believe that under that circumstance that the price of gold plunged from 1,700 to 1,200. I mean, the whole scheme is falling apart. And so when the chairman of the Shanghai Gold Exchange says flat out, this gold system we have, where it's accumulated in the East and priced in the West, is going to go away. We're going to make sure that you should take heed, because he who has the gold wins. And in the end game, China's going to have the gold. Well, anyway, there's so much more that I could discuss here, but suffice to say, this should be enough to chew on for a weekend. It's truly scary how quickly the Fed is losing control, and once that challenge to dollar hegemony occurs on a grand scale, which it very well may be any day now, if you haven't protected yourself with physical gold and silver, it's going to be too late. And thus, we hope, if you do decide to do so, that you'll give us a call here at Miles Franklin. We're here to, or answer your calls all week long, 800-822-8080. We've been around for 25 years. We're the best in the business. We give you the best service, competitive pricing. And of course, you can email me at any time at ahoffman@milesfranklin.com. Thanks, and have a good weekend.